Hello and welcome to this webinar on interest rates, property and investment outlook 2023. My name is Sam Wylie. I'll tell you a bit about myself in just a moment, but let's just jump into the webinar. Here it is. You can get a copy of these slides by going to our website if you don't have a copy already. This is the seventh in a series of webinars that I started during COVID to explain global economic events and outlooks for different types of investments. I've been a bit slack this year because I've only run this webinar instead of the two that I've run in previous years. Actually, I've been the opposite of slack. I've been super busy this year, but I'll try and run more webinars in the future. So what are we going to talk about tonight? Well, we're going to talk about Aussie interest rates and US interest rates and whether they're going up or down. And I'm going to argue that the Reserve Bank of Australia is a long way behind the curve in controlling inflation, and it's going to have to raise interest rates 2 or 3 times more, perhaps even more than that. And then we're going to turn to residential property outlook and what the outlook is for real property prices with adjustment for inflation. And I'm going to explain why I think that property prices will go up in the short to medium term, as much as 10%, but then they'll be flat for a considerable period of time. And I'll explain why I think that these two things go together, interest rates going up and property prices going up in the short run as we go along. Then I'm going to turn to property investment strategies at the end of the webinar and talk about what it is to have a consistent property investment strategy. I'll remind you of what that means, to be consistent about what it is you're investing in, where you hold the assets, and how you manage risk. You've got to get those three things together. The what, meaning, am I invested in apartments or in houses in leafy suburbs or in houses in outer suburbs or somewhere in a regional area, etc. What type of investment have I got? Where am I holding the investment? Is it in my self-managed super fund? Most likely not. Is it in my family trust? Am I holding it directly, such as I should expect to do if I am undertaking negative gearing? And then how much leverage do I want? And then my implementation strategy. Those things have got to go together to have a coherent investment strategy. And there's a different combination of those things for different types of property strategies. And I'll just remind you of that when we get to the end of the webinar. And I'll also introduce, show you how real interest rates and inflation, and the expected real growth in property prices, how those three things feed into expected returns to negative gearing strategies. So we're going to finish up on strategy. Just a little bit about myself. So I studied engineering at the UWA, where I met my beautiful wife, Tracy. We have 3 young adult children in their early to mid-20s. We went to Canberra. Tracy worked Prime Minister's Department. I worked for the federal government as well. Studied economics part-time, did a master's degree at the ANU, won a scholarship to the London Business School, to the University of London to do a PhD in financial economics. When we finished there, we went to Dartmouth in the States, Dartmouth University in the US in 1997. We were there until 2004 when we came back to Australia. And I wanted to go to the University of Melbourne, to the Graduate Business School of the University of Melbourne, because this is the best university and the best business school in Australia. But we live in Perth, as many of you know. So I've flown backwards and forwards across the Nullarbor 400 times. Nowadays, since COVID, my activities at the business school are much curtailed. It's no longer writing research and teaching courses for me, except I still teach executive education. It's mostly running my consulting business with companies such as these ones, working with the media, and of course, running our teaching business with Tracy. Okay, let's get right into it. So the RBA is still behind the curve in fighting inflation. Now we're talking about interest rates. How do we know that? Well, let's look at some historical data to do with interest rates. Here we're going all the way back to 1990, and we've got the US Fed funds rate. So that is the overnight interest rate, benchmark short-term interest rate set by the US Central Bank, the Federal Reserve, and the cash rate is the Aussie dollar overnight interest rate, benchmark short-term cash rate, interest rate set by Australia's central bank, the Reserve Bank of Australia. Now you can see that historically and ordinarily, the RBA, the interest rate set by the ABA is 150 to 200 basis points, 1.5% to 2% higher than interest rates in the US. The short-term policy interest rates, as we would call them, in Australia are higher than in the US ordinarily, but not at the moment. And this is because the Fed, which itself is behind the curve, meaning slow to act against inflation generated in COVID-19. The Fed, which itself is behind the curve, acted more quickly and with more force in raising interest rates than the RBA has. And so now we have the cash rate of 4.1% in Australia and 5.25 to 5.5% range in the US. So it's unusual. It's just a measure of the Fed having taken inflation more seriously or having acted more strongly against inflation than the RBA. Now, you can see when we look at policy interest rates in other countries, Switzerland has traditionally, has for a long time had low inflation, but other countries similar to Australia, their policy rates are higher than Australia. The EU, which is not in this graph, is at 4.5%. We're down here and really behind the curve in acting against inflation. Now, another measure of how strongly a central bank is acting against inflation, the tightness of monetary policy and of financial conditions. There's other things that go into financial conditions, but interest rates are a key part of that. Monetary policy, fiscal policy is spending by governments, and monetary policy is the setting of interest rates, as well as the volume money, quantitative easing, but the setting of interest rates by central banks, that's monetary policy. Fiscal policy is spending, the amount of spending and the size of budget deficits or surpluses by central governments, by federal governments around the world. Now, both of those things were massive in COVID, and that stimulus combined with constraints on supply, that increase to demand, stimulus to demand, combined with constraints on supply, created a big burst of inflation, of course. And inflation has peaked and is coming down, but nonetheless, the RBA is somewhat behind the curve. And a measure of whether how strenuously a central bank is acting against inflation is the real interest rate. How high the interest rate is above inflation. How high the Fed funds rate is above US inflation, how high the cash rate is above Aussie inflation. And here we're looking at the US, and this is the Fed funds rate, and this is the real interest rate, the blue line. How far the Fed funds rate is above inflation. Now, inflation is the thing that the central bank's trying to control, and the Fed funds rate is the lever that it can move up or down. Now, if it moves the Fed funds rate, the policy interest rate above inflation, then it's trying to slow down the economy and squeeze inflation out. Now, you can see that in periods of when it's been trying to do that, it's taken the real interest rate, it's taken the Fed funds rate a long way above inflation. That's what the blue line is, how far above inflation. And so when they're fighting inflation, the central banks take the policy interest rate a long way above inflation. They take the real interest rate to high levels. And when they're fighting deflation, such as was occurring after the GFC, between the GFC and COVID, mostly the Fed is fighting deflationary forces and trying to stop inflation from going negative. And when they do that, they take the Fed funds rate below inflation. And of course, here, the Fed funds rate was taken down to zero. Inflation down to about 2%, the Fed funds rate down to zero. So this real interest rate was negative. That's in the period between the GFC and COVID. And now the central bank in the US, the Fed, has taken real interest rates back into positive territory to fight inflation. And they're going to take this even more positive, not so much the Fed funds rate going up, but inflation coming down. If they hold the Fed funds rate steady and inflation comes down, then the real interest rate will be higher and financial conditions will be tighter. They'll be fighting inflation harder and harder just because the real interest rate is higher. Now, you compare that to Australia, and here's where we are. The same blue line in the US, measuring the real interest rates, how much the policy rate is above inflation, which has gone positive in the US, still very negative in Australia. Now, let's compare that to Australia. You can see here that the cash rate in Australia is 4.1%, inflation's at 5.9%, and the real interest rate's at minus 1.80. This is stimulatory. This isn't restrictive monetary policy. This is what you would typically see if we were worried about deflation. Now, the RBA thinks that what's going to happen here is that they're going to keep the cash rate approximately at 4.1%, and inflation is going to fall, and this real interest rate is going to go from being negative to being positive. That inflation is going to fall down here to 2.5 or something, and the real interest rate will go to 1.6. That's what they're expecting to happen. Or that they're trying to get back to a real interest rate. Something that I should point out to you here about real interest rates is that there's before and after the GFC are very different conditions in real interest rates. Now, remember I said at the beginning of the webinar that at the end of the webinar we're going to talk about the relationship between inflation, real interest rates, the real growth rate of property prices, and investment strategy, and the returns to investment strategy. Now, here I'm pointing out to you something about real interest rates, short-term real interest rates, which feed into the mortgage rate in a way that we'll talk about as we go along. That before the GFC and after the GFC is very different. And what we return to now in the post-COVID world, in terms of real interest rates, whether we return to something that is more like pre-COVID, more like pre-GFC, or more like after the GFC, really matters. I mean, here we're back to US data, and you see that the average real interest rate, this thing, the amount that the Fed funds rate is above the inflation rate in the US before the GFC. We go back to here. Here's the GFC. This is the dot-com bubble, the washout of the dot-com bubble. But let's just think about the whole period before COVID. Then real interest rates were around 2.5%. The Fed funds rate was about 2.5% more than inflation on average in this period, 2 to 2.5%. After the GFC, it was about minus 1.5%. So let's say 2% on average across this period, minus 1.5%, and that's a difference of 3.5%. There was just a regime change in the real interest rate. And this is crucial for property investors because unlike in the US where most mortgages are fixed rate, in Australia they're mostly floating rate. And so it's the cash rate plus a spread that is the mortgage rate. But in any case, this was a crucial change, and we don't know whether we go back to this or whether we go back to that. And in Australia, we don't know post-COVID, whether we go back to this, real interest rates of about 0, or whether we go back to that, real interest rates of about 2%. Now, presumably, the RBA thinks we're going back to here or something a little bit more than that, and that they'll be able to maintain the cash rate and get to a tight real interest rate just by inflation falling, without them having to raise the cash rate a lot, because they're paused with raising the cash rate. I don't think that's right. I think that they are underestimating the tightness of labour markets and how the tightness of employment and labour markets is going to lead into wage pressure, which will drive up inflation expectations. So let's look at some data on that, on how tight the labour markets are in Australia. So this is Australia's unemployment rate, and we can see here that it's at a record low. It was lower in the 60s, in the 50s and the 60s, but that was just a different world. You know, female participation in the labour market was half in this period what it is today. So that was just a different labour market. And really, this is a record low level of unemployment, 3.5 to 3.8, depending on what the participation rate is at some point in time. And we can see, now we're just zooming in on this, the unemployment rate is a lot lower now than it was pre-COVID. And we might think that that's because a lot of people have left the workforce, but that's not true. A lot of people have entered the workforce. Pre-COVID, there's 13 million jobs in Australia, 13 million employees, and now there's 14.1 million. 1.1 million new jobs have been created. And then we might think, oh, well, they're all part-time jobs. So people have moved from full-time to part-time. But that's not true either. Almost all the new jobs that have been added are full-time jobs. And the ratio of full-time jobs to part-time jobs has actually gone up, which is another measure of just how tight the labour markets are. And coming down here, we can see the same thing. Now we're measuring total hours worked and seeing how much higher that is post-COVID than pre-COVID. And when we come down here, we can see the participation rate. This is very high by global standards. This is much lower in the US. I think we'll see the US figures in just a bit. Much lower in the US, but by global standards, this is very high participation rates in Australia, both male and female. Now, the wage price index in Australia hasn't surged that much. It's still under 4%. This is the RBA, the Australian Bureau of Statistics wage price index. There's other price indexes. There's a good one that's produced by SEEK, the employment company, and they have good visibility on the wages that people are, the wages of the jobs that people are going to. And their measure is about a point higher than the ABS up here, about a point higher. But in any case, we don't know how high this is going to go. And there are considerable lags in employment in Australia because we have a centralised wage fixing system. It's not entirely centralised, but there is a lot of centralised wage fixing. The centralised fixing of minimum wages. There are awards that people work to. There are employment bargaining agreements. And so those things take some time to change. There's a degree of momentum or inertia, I should say, in the labour markets in Australia that there isn't in the US, which is much more market oriented. So once demand starts to exceed supply in the US, wages start to go up, but there's more inertia in Australia because of the centralised nature of wage fixing. But in any case, the real issue is down here. The real problem is to do with productivity because it's unit labour costs that drive inflation. And even though wages aren't that much up in Australia, unit labour costs are way up. And this will feed into inflation, especially into services, which are by far the biggest part of the economy, and put more and more pressure, upward pressure on inflation. So what I'm saying is that I think that the RBA is underestimating. I mean, it's not like they don't have terrific economists or not. I mean, they're making good judgments. But I think that they are underestimating the amount of wage pressure that there's going to be in Australia, the effect of the tight labour markets, and that they're too sanguine about the threat from inflation. The threat that inflation is not transitory, but that it proves to be more permanent. To say that inflation is transitory is to say that pressures come along which drive prices up, but it doesn't re-anchor people's inflationary expectations. It doesn't matter. Transitory is not about how long an inflation surge occurs for. Transitory is about whether it shifts people's long-term expectations about inflation. You know, I mean, transitory means that when people go into bargain using unions, with their union or by themselves to bargain their employment conditions, if they say, well, I need 15% because inflation's been 15 over the next 3 years because inflation's been 15% during COVID, they're still looking backwards. They're not looking forwards. It's not a change in their future expectations. If they go into the negotiation and say, I need 15% because I think inflation is going to be 5% a year over the next 3 years, that's a re-anchoring of inflationary expectations. That's a shift from transitory inflation to more permanent inflation. And once inflation becomes more permanent like that, when inflationary expectations have been re-anchored for companies in setting their prices and for employees, then it's really hard to reset. Now, the RBA thinks it's transitory. It thinks that we will be back to the world of fighting deflation before you know it, and that we're not going to have to go very high with policy interest rates before inflation starts to fall and we're back to positive real interest rates. I think they're too sanguine about the tightness of the labour market. Okay, now we should just recognise that wage inflation, there's different ways of measuring inflation. Most people want to look at core inflation of some kind, but there's different ways of measuring inflation. But the most core type of inflation is wages. So wages are like the super core of inflation. You know that we take inflation, consumer price index. There's the standard consumer price index in the US and Australia and around the world in different currencies. And then to go to more core, we might take out the most volatile elements like food or energy and go to core inflation. Or we might trim off whatever is the most volatile at some point in time, a particular point in time, and just take the mean of what's left over. That's what the Australian central bank does, is it uses trimmed mean inflation. The Fed actually uses not core inflation, but personal consumption expenditure as a measure of inflation. You see, the good thing about looking at how much personal consumption expenditure rises is it takes into account people's adjustments of the basket of goods that they consume, because prices can change, but people change what they actually buy when prices change. And the CPI itself doesn't adjust for that, but personal consumption expenditure does. So the Fed uses personal consumption expenditure with the most volatile elements taken out, with food and energy taken out, core PCE, to measure inflation. Wage inflation is like a super core, because ultimately wages are inflation plus productivity. Anyway, let's have a look at the tightness of the US labour market. And we can see it also is at a historic low in terms of unemployment. And here we are adding something to this graph of US unemployment. And what that is the level of inflation. So this is the consumer price index with food and energy taken out. So this is not personal consumption expenditure, but just core inflation, CPI with food and energy taken out. And you can, just by eyeballing this, let alone with doing any equations, doing any math, just by eyeballing it, you can see that the correlation between CPI and unemployment isn't that strong. But it's not the overall correlation that matters. It's what happens when unemployment is extremely low. Now, when unemployment hits record low levels, inflation rises quickly. That's what we can see here. When unemployment goes down to record low levels, inflation pressures build. And that's what will happen here. So inflation has fallen off because supply constraints have been released. There's a big surge of inflation caused by all of the stimulus from cutting interest rates and from quantitative easing, and especially from government spending. Inflation's fallen back, but there's a danger that inflation gets reignited in the US, or at least that inflation falls down to 4 to 5% and levels out there, and that it doesn't quickly fall back into the Fed's target rate of 2 to 2.5%. The Fed consistently says it's going to keep interest rates high and continue quantitative tightening, the opposite of quantitative easing, until it gets back to 2% inflation. The target for the Reserve Bank of Australia is more 2 to 3%, but nonetheless, with the tight labour markets, it's going to be very difficult for the Fed to do that. Record tight labour markets and inflation falling back to 2%, those two things really just don't go together, and that's what we can see in the historical data. Okay, now another thing is, these are the monthly growth job figures in the US. And this blue bar down the bottom here, this blue bar is showing us the level of new jobs that are needed just to maintain unemployment at its same rate. So, I mean, the US population continues to grow. The US needs 100,000 new jobs per year just to stop unemployment growing, to maintain the same level of unemployment. Well, they haven't been below that figure for the longest time. We've consistently had high job growth figures in the US. Any figure that is above this bar means that the labour market is tightening. The number of jobs is growing faster than the workforce is growing. And it's been consistently higher than that. And it's rising again above that. The labour market gets tighter and tighter. Now, it's also true in the US that the falling participation rate amongst males and females in the US, that's come to an end. So there was a special concern about people between the ages of 25 and 54 in the US who had dropped out of the labour market. Well, they're back. I mean, to begin with, it was about people retiring, and then it was about the 25 to 54-year-olds. But now the labour force participation is back to where it was pre-COVID. And so that means that there just isn't this big pool of workers to tap into for people to come back into the labour market. Just before we go on to continue to talk about other factors driving inflation, let me just say a couple of things about my investments course. So I have an investments course which runs for 10 weeks, and it's on Monday nights. It starts on the 9th of October and runs for 10 weeks. I've run this course many times. Many of you who are watching this video have taken the course. I hope you'll agree that it's very good. It's intended to help people with their feeling of empowerment and also getting to better outcomes in their investing. So many people feel very disempowered in their investing because there's the feeling that there's something big that they don't know about investing, and the feeling that they don't know where to start, how to get traction, they don't know who to turn to, and who to trust with help with their investing. That's such a problematic thing. And they're worried that they'll make big mistakes. So it's a very disempowering feeling, and it leads to inaction and the failure to properly create and implement an investment strategy. And people get to much worse outcomes because of that. So this is all about empowerment and getting to better outcomes. And empowerment, by working through week by week, step by step in a very structured process, me giving you the tools and the examples through narrative examples of fictional characters working through our steps, giving you the tools and the structured opportunity and the examples to work through and find out what's right and wrong about your investing, and to fix what's wrong and to amplify what's right. That's what the course is all about. And that doesn't assume that you know anything about finance. It's not mathematical. There's a few equations appear in this webinar, but hardly any equations of any kind appear in the course. It's not mathematical. It's not technical. It's just very practical, step-by-step process of finding out what's right and what's wrong about your investment, and fixing what's not right. So it costs $1,200 plus GST per household. So it means that everyone in your household can do the course together, which is an extremely helpful thing. If you want to get some more information on it, go to windlestone.com.au, and there is a long video there called 7 Mistakes That Investors Make. If you watch that, you'll get a really strong flavour for what the course is like. It's run on Monday evening, starting on the 9th of October. You can either come to the live classes, which run for 2 hours, or you can watch it on video on demand, or you can do both. A lot of people do both. And the materials are available into the second quarter of 2024, so there's plenty of time for you to do it if you miss any classes. All right, back into our discussion here. So let's talk about some other factors driving inflation. And we've been talking about rising wages as being a powerful pressure, but there's others. So there's the immigration driving demand, and we'll start talking about housing prices, about how powerful immigration is into Australia at the moment, what a surge of immigration there is. There's higher energy costs through energy transition. This is unavoidable, the decarbonisation of the economy, but it does involve powerful inflationary forces with energy costs. And the cost of housing, high commodity prices in Australia at the moment, the weak $1, meaning that imports cost more. And raised against that is a set of factors which the RBA thinks will cause inflation to fall relatively quickly, improving supply chains, the unblocking of logistics and supply chain blockages for goods especially, but services are a bigger part of the economy, much bigger part than goods. Low consumer confidence, I'll show you what that looks like. That's at record lows. Low consumer confidence feeding into slower retail sales and slower GDP growth. GDP will be about 1.8% this year and about 1.6% next year by projections. They're the OECD projections. That's pretty slow relative to historical growth in Australia, but certainly not a recession. Immigration will loosen some of the labour market tightness, and the RBA has warned continually about the permanent slowdown in the Chinese economy being a factor that will affect the Australian economy. But I would say to that, I agree with that, but that's sort of further, that's further out than the problems that we have with inflation right at the moment. Okay, let's have a look at some of these factors before we start talking about housing prices. So this is consumer sentiment in Australia. This is extremely low at the moment. See, this is COVID-19, and this is consumer confidence relative to COVID-19 in the present. This is presumably the effect of higher interest rates and high petrol prices and the like. But it's remarkable how low this is at the moment. Even going all the way back to the GFC, for instance, the GFC, COVID, and the present. This feeds into the RBA's thinking about what retail spending is going to look like and consumption is obviously the biggest part of the economy. So they're definitely worried about this. They're worried about China. They're reluctant to put up interest rates when facing this low consumer confidence and some problems associated with Chinese growth and feeding into demand for the commodities that Australia exports. But I think it's putting them a long way behind the curve with inflation when you look at how tight the labour market is. But it is amazing that across these four, I mean, these are four different surveys that are being averaged here. Roy Morgan and the RBA survey and Westpac and the Melbourne Institute. This is, a very striking feature of the Australian economy at the moment. Just in terms of commodity prices, you can see here that commodity prices have been at record levels through COVID, which has been tremendously stimulatory for the Australian economy. And really since 2000, the Australian economy has been hitched to growing commodity prices caused by the extra demand from the surge in growth in China in particular. And if China turns down, commodity prices will turn down. Some of the slack will be taken up by other growing economies, but commodity prices are likely to turn down, and it's long-term trouble for the Australian economy. But here, in terms of inflation, we're really thinking about what's going to happen in months and quarters and 1 or 2 years, whereas this is sort of a multi-decade issue that we're talking about with commodity prices and the terms of trade. Another thing that we might want to think about is the RBA's balance sheet and quantitative easing and the term funding facility of the RBA. When a central bank makes its balance sheet bigger, here we've got the assets and the liabilities. I know we would ordinarily have the assets on the left-hand side and the liabilities on the right-hand side, but it suits me to put it around this way. But here you can see how much bigger the RBA's balance sheet got. And when a central bank's balance sheet expands, it is loosening financial conditions. And that's why I put it here. And just to show a couple of things, the RBA is not undertaking quantitative tightening, unlike the Fed. It's leaving that quite loose. The new money that was created by the buying of government bonds, classic quantitative easing, the buying of bonds and the creation of new money to buy those bonds in the COVID crisis, that's not being unwound, or it's only being unwound very slowly in Australia. The term funding facility, the lending of money to banks at very low interest rates, the RBA lending $188 billion to banks at just 0.1% interest rate for 3 years fixed, which banks then lent on at 2% or thereabouts, or a little bit more or a little bit less, to households. And those very low 3-year fixed interest rates, which stimulated the housing market, which drove housing prices up, that thing is starting to unwind, but only slowly. I'm just sort of pointing out here that the Fed is unwinding the size of its balance sheet, and the monetary stimulus from expanding its balance sheet relatively quickly. And the RBA is not doing that. The term funding facility is starting to turn off, and this will come down to zero over time, longer period of time than I'm pointing to, but it'll come down to zero. But it's not the case that the RBA is draining a lot of liquidity quickly from the economy like the Fed is. Okay, now just going to remind you of the inflation scenarios that we've been looking at in previous webinars. And here what we have is what the RBA really thinks is going to happen. They think that inflation is going to fall quickly, and that before you know it, we will be back to a world where we're not trying to force inflation down into the RBA's 2 to 3% band. We're trying to stop the inflation falling out the bottom. We'll be returning to the world where we're fighting, here I say the Fed, but I mean the RBA as well, where we're fighting deflation. Turning from a world where we're fighting inflation, the inflationary impulse created by all of the very loose monetary policy and loose fiscal policy, cutting of interest rates to zero, all that quantitative easing, that's monetary policy, all of that government spending, trillions and trillions of dollars of government spending, that's fiscal policy. That stimulus caused inflation. But in this scenario, inflation falls quickly. Now, inflation has fallen quickly and then leveled out a bit, But they think, and many in the markets also think, that inflation will fall quickly from here, and before you know it, we'll be back to fighting deflation. Now, in a reversal scenario, which I favour, and this is what I laid out in the previous webinars, is that inflation, yes, will fall quickly, and it has, but then getting inflation all the way down. It's one thing to get inflation in the US down from 9% to 4.5% for PCE, core PCE inflation. It's another thing to get it all the way down to 2. And this won't be easy. And there'll be a significant period of time where the Fed, and here in Australia, there'll be a struggle to get inflation down. It'll come down, but it'll level out because of the pressures in the labour market feeding into wage inflation, and especially through the services channel. There'll be a period where interest rates have to be maintained, even raised, and quantitative tightening has to continue until we can get inflation all the way down into here, a significant period of time. And I think that's the period of time that we're in. And it'll take extra interest rate increases in Australia and in the US as well, most likely, but especially in Australia because the RBA is well behind the curve. Now, on the basis of that, do you want a fixed rate or do you want a floating rate mortgage? Let's just sort of think about that for a bit here and look at the benchmarks for floating rate and for fixed rate. So floating rate mortgages, these are taken from Rate City. Floating rate mortgages, and I should also say, just before I go on, they were thinking here of an investment property that was purchased for $1 million and has a loan to valuation ratio of 80%. So the investor's putting 200,000 of their own money in and borrowing 800,000 in an interest-only loan. Why do you want an interest-only loan for an investment property? Well, we discussed that in previous webinars, and if you're not familiar with that, then that's the kind of thing that we go through in my course when we're talking about property. We talk about other asset classes, shares and bonds and infrastructure and the like, of course, commercial property in my course. But when we're talking about residential property investment, which is a significant part of the course, then that's the kind of thing that we go through. Why you want an only interest-only loan. 99% of the time, investors, people borrowing for mortgages for investment properties want interest only. So that's the example here. LVR of 80%, investment loan, interest only, floating rate, fixed rate. I've taken the very lowest interest rates that you could see on Rate City. I've just sort of gone down until we start to see the kind of banks or building societies that we actually recognise. And on the floating side, what's going to drive it up is not the bank spread, but the cash rate. If the RBA is forced to put the cash rate up, this will go up. The spread will stay about the same. This is the cost to the bank of originating the mortgages through broker channels, etc., the return on equity, and other costs that they have. And over here, the benchmark for fixed rates is the rate at which the federal government can borrow money for 3 years, plus about the spread that the bank needs to make money. So floating rates, the rate at which banks can borrow money on a floating rate basis, which is approximately the cash rate. It's actually the bank bill swap rate, but it's approximately the cash rate plus a spread, the rate at which banks can borrow money for 3 years at a fixed rate plus a spread. And this is actually the rate at which the government can borrow money. But in any case, what will drive this up is the cash rate going up. And it's quite possible that the floating rate will go up without the fixed rate going up, that the yield curve will steepen, that the yield curve, the rate at which investors can borrow money will change, but it'll become higher at the short end and remain fixed at the longer end. But in any case, it's quite possible the cash rate will go up without this rate going up. And that would make fixed more attractive than it is at the moment. I quite like fixed for 2-year mortgages at the moment. Beyond 2 years, I think we're going to be getting into the territory where the RBA will be cutting interest rates. But if we think that the RBA isn't going to be cutting interest rates until 2025, which I think is quite likely, I think they've got a couple of increases in front of them to control inflation, 2 or 3 increases from here. But then somewhere into 2025, they might start cutting interest rates, because anything could happen. I'm just projecting what I think is going to happen. So I quite like 2-year fixed mortgages at current rates. But beyond 2 years, in 3-year fixed mortgages, I think it's very even between floating and fixed. All right, let's keep going and get into talking about residential property prices. Now, I think that residential property prices are likely to rise in the next 12 to 24 months by something like 10%. Look, I don't know exactly. It's really the direction that I'm pointing to. But a modest rise in real property prices. And it's because of these things: strong population growth and constrained supply. So a lot of demand being driven by population growth, rapid population growth, and constrained supply. And so rises in real house prices despite interest rate uncertainty. Now, on this side, we also have low consumer confidence and very high existing prices. Let's have a look at real house prices in Australia. So this is since 1970. I set both the US and Australia to 100, to an index value of 100. And they are close to each other. We shouldn't say they track each other, because one doesn't cause the other, but they're coincident until the GFC. And then they're really quite divergent, housing prices in Australia and the US. And let me just remind you that these are house prices with inflation taken out. So these are real increases. And here in 2017, real house prices were considered to be so high in Australia that the banking regulator, APRA, the Australian Prudential Regulatory Authority, and the RBA acted against banks lending more money. So APRA said that banks are not allowed to grow their loan books by more than 10% per year, and made other capital requirements. And the RBA just sort of tried to influence banks to sort of eyeball them, in a sense. The central bank can do that, to tell them, don't increase your lending too quickly. But so there was both sort of persuasion, and especially there was constraints on their growth and extra capital requirements. And that's because they thought this was a bubble, that real prices had reached such a high level by 2017 that they needed to act against the bubble in the property market. Well, that bubble got bigger in GFC, in COVID. That bubble was inflated even more, especially by the term funding facility. All of that lending by the RBA to the banks, 188 billion, which was lent on to Australian households at incredibly low interest rates. I mean, people were getting 3-year mortgages in September 2020 and beyond, through to June 2021, 3-year mortgages at 1.75%, fixed at 1.75%. I hope you've got one of them. Unfortunately, it'll be rolling off over some stage in the next 12 months. You'll need to refinance at something more like 6%. But at least I hope you had that low capital to finance your mortgage for those 3 years. That really drove real house prices way up. Now, they've come off, of course, by 10 to 12%, but I'm expecting them to rise again under the pressure of low supply and high demand driven by population. And then for housing prices to be relatively flat, for real house prices to be relatively flat for a considerable period of time, or for growth not to match the very high growth that we've had over the last 30 to 40 years. Now, let me just say something about structural headwinds before we go on to talking about supply and then about population growth. Let me say something about why I think that housing prices will be relatively flat after short to medium-term effects drive housing prices up. And it's what I have referred to in previous webinars as structural headwinds. There's these structural problems in the housing market experiencing the same kind of growth, very high real growth, in the next 30 years that it's experienced in the last 30 years. And it's this, that the ratio of house prices to average household disposable income has gone up from about 2.5 in 1990 to 5.5 now. Now, if you want house prices to go up as much in real terms in the next 30 years as they have in the last 30 years, then there's got to be a continuation of this. And that's not really feasible. So house prices could go up relative to incomes by this amount because interest rates came down. Interest rates came down so much since 1990 when the cash rate was at 13.5%, and there were some mortgages way up here above 15%. A lot of mortgages were capped at 12% by the government, but some mortgages were being written at nearly 17% up here. And now mortgages are being written up closer to 6%, as we were saying just a moment ago. And that reduction is what allows this to occur, for the ratio of house prices to income that can support those mortgage payments to go up to here. But interest rates can't fall another 12% or another 10%. They can't go from being here to being way down here. That's not unlikely. That's impossible. And so we can't expect this thing to be extended. And that is what's driven this. Now, in your investment strategy, as we'll be saying in just a moment when we turn from house prices to talking about strategy, if you have a negative gearing strategy, then that's a strategy of growth. And you've got to go where there's growth. Now, you don't need very much growth, and you can get growth from inflation as well as real growth. But nonetheless, you've got to go where there's growth, and you've got to be realistic about the growth not being as great as it has been in the last 30 years because of these structural headwinds. But we don't need the growth to be as great as it's been in the last 30 years. And I'm going to show you that when we get to some examples about strategy and negative gearing in just a bit. But we need to be realistic about those structural headwinds. And that's why I say we should expect this to be a lot flatter over the next 30 years than it's been over the last 30 years. An upward surge because of low supply and high immigration, but then flatter growth than we've had because of structural headwinds. Okay, now over here we're talking about how much debt households have, and there's a limit to that as well. But in any case, let's turn to supply. Housing supply is running at, these are monthly figures, so housing supply is running at about 150,000 per year. The government is shooting for 1.2 million. The target was building 1 million houses in the next 5 years. But because we weren't meeting that target, the premiers and the Prime Minister got together and decided that the target's now 1.2 million. Because we couldn't reach 1 million, they moved the target up to 1.2 million. I really don't know how to describe that kind of behaviour. That's somewhere between Kafkaesque and sort of 1930s style Soviet centralised economic planning. In any case, a little bit dispiriting, but we are nowhere near on target to do that. We're on target to build something more like 850 to 900,000 houses. And during that time, we are expecting to have a surge of population. But just before we get to that, let me just point out that the supply problems that we have, which are the inertia of bureaucracy, local resistance to building more houses in people's areas, and skill shortages, none of these things are easy to overcome. Now, coming out of the conference that I was so disparaging about in just a moment was a commitment to ease bureaucratic burdens, to speed the whole thing up, to ignore local resistance, and to bring in more skilled people to build houses through the immigration process, a commitment to this. But I'll just believe that when I see it. I'm not convinced that that's going to happen. There's a lot of talk about that, but there's been a lot of talk in the past as well. I think these are very difficult things to change. And so, just not building houses nearly fast enough. You can see down here, the average housing completion rate, these are for houses. It's a bit different for apartments, where there was a real surge in apartments over the last 10 years. But actual houses, the number of houses we build today is approximately the same as it was 40 years ago. 45 years ago, Australia's population was a half of what it is now. It was 13.5 million in 1978, 45 years ago. But we are building the same number of houses now as we were building 45 years ago. As I said, a little bit more with apartments, but this notion that we're suddenly going to solve the problems associated with building houses I think is really ridiculous. So I put in a couple of slides here about the growth in rents, which is very enticing to property investors, and being driven by this lack of supply and the surge in population. And here is the surge in population. Australia's population on average grows at 1.6% all the way back to Federation, to 1900. Our population has been doubling about every 45 years. That's what happens when you grow at 1.6%. But it's entering a surge phase at the moment where it's growing a lot faster than that. And this is going to go on for some time. When we look at this in actual numbers terms, the number of people coming to Australia, several million people are going to come to Australia in the next 5 to 6 years. And we're not building the houses for that. If no one came, it would take ages for us to get through the housing backlog that we've got. But, 3 million people are going to come in the next 5 years or so, 5 or 6 years. So real supply problems and a big surge in population. And you can easily get data on a state-by-state basis. And, you should look at how large the population surges are in different states. I like housing in WA. I'm not trying to provide financial advice here, but I do like it. It doesn't really make sense in diversification terms for Tracy and I to invest in more property in WA. But I should just point out that this graph in WA is very flat. Real house prices in Western Australia, despite its dynamic economy, are no higher than they were in 2005. If you just took Western Australia instead of the whole of the nation, this actually goes down and then back up, but it doesn't go up any higher than it was in 2005. And now you've got a big surge in population. But in any case, population is a very strong driving factor. And we've got a surge in weekly rents as well, which is part of the reason that I'm expecting housing prices to go up. Okay, let's turn to property investment strategy. And let me just remind you of what it is to have a coherent real estate investment strategy. So it means that these things go together. What you're investing in. So am I investing in houses or in apartments, new apartments, in old apartments, in houses in leafy suburbs, houses in new housing developments? Which is it? Am I investing in high-yielding houses in a regional area? Am I investing in houses in Yamba, in Queensland, or in Bendigo, in Victoria? Or am I investing, which is going to be high-yielding but relatively low growth? Or am I investing in houses in leafy suburbs, which are going to be very low-yielding but higher expected growth? Where am I positioning myself in the market? Strategy ultimately is all about positioning. Where am I positioning myself in the market? And then what kind of structure am I holding the asset in? Am I holding it in my self-managed super fund? That's unlikely. Am I holding it in my family trust? That's very common. Am I holding it direct title over the asset, because I'm undertaking a negative gearing strategy? So look, these three things would go together. We buy a high-yielding apartment or a high-yielding house in a regional area. We buy a high-yielding apartment. We put it in the family trust so that when it throws off a lot of cash, we can distribute the cash where we want and achieve tax effectiveness. So we buy a high-yielding apartment, put it in the family trust, and we don't have too much leverage because we don't need to have a lot of leverage. It's not really a part of the strategy. And we just set the leverage to what matches where we are on the risk spectrum. That's a good strategy. That's coherent. That's what I mean by the parts of what are we investing in, where are we holding it, how much risk are we bringing in, those parts going together. Or we might decide to invest in a low-yielding property, a house in a leafy suburb with low yield but higher expected growth. We might own it directly so we can negatively gear it. That is, when it makes a loss because the rental income is lower than the interest payments, we can deduct that loss from our salary before we pay income taxes, negatively gear it. So low yield, high growth, house in a leafy suburb, directly owned for negative gearing purposes, and highly leveraged, and maintaining the high leverage so that the negative gearing strategy works better. So those three things go together. And notice that it's quite different to the combination that we had for the high-yielding apartment. So those are two different but coherent strategies. Now, if you mix up the strategies, so if we, borrowed a lot of money to buy an apartment which we held directly, that's a mistake. People make that mistake all the time. That's mixing up your strategies. And it's not being coherent. This is what I mean by a coherent investment strategy. I'm just reminding you of the importance of that. Now, again, this is something that just in purely practical terms, really understanding that at a deep level is an important part of our discussion of property in my investments course. Now, let me turn to something else about strategy, something sort of new here. And that is to talk about how inflation, real interest rates, which we've been talking about in this webinar, and the real growth rate of property go together and influence a negative gearing strategy. Let's use an example for that purpose. So let's take an example, and let me sort of walk you through this example. And what we're going to find, let me just jump to a result here, is that inflation is the property investor's friend in this negative gearing strategy. Seems like inflation should not be your friend, but it actually is your friend in this strategy. So in a negative gearing strategy. And I want to take you through why that's true. Inflation is a property investor's friend, and real interest rates are the enemy. Let's work through that in the example. Let's understand these things. Or let's imagine that we buy a rental property, a house in a leafy suburb, and it costs $1 million. I know that's not going to buy much in most cities, but it's a nice round number. So we borrow $800,000, we put $200,000 of our own money in, and then we rent it out. And when we rent it out at a low rental yield. Let's imagine that our net rental yield is only 1.5%. So we're only getting $15,000 in rent on the $1 million property after we take out some outgoings like insurance, like rates, like strata title, if that was an issue, unlikely to be an issue for a house. But if we take out insurance, rates, agents' fees, etc., we get down from what might be 2% gross to 1.5% net, how much actual cash we've got. Let's not worry about this for the moment. Let's just say we've got a 1.5% yield. And then that's money coming in. The money going out is the interest payments. And the interest payment is made up of this: the cash rate, which is inflation plus the real interest rate. Remember, that's what the cash rate is, plus the mortgage spread, the 220 basis points. So let's say we've got an inflation rate of 2.5, a real interest rate of 0, and a mortgage spread of 2.2%. Now, let me remind you of those things. So this is inflation. Let's just go down here. Let's say inflation is 2.5%, that the RBA gets inflation back into the middle of its target zone, that the real interest rate goes back to 0, back to here, not back to here, but goes back to pre-COVID conditions. That's what's being assumed here. So that the cash rate and inflation will be approximately the same thing if the real interest rate is 0. That's what I'm assuming up here to begin with. Real interest rate 0 on our $800,000 of debt. The net rental is on the total value of the property. The interest rates are on the $800,000 of debt. And we've got inflation plus the real interest rate. That gives us our cash rate. And then on top of our cash rate, we got a mortgage spread. That's what this was. Sorry to flash through the slides like this, but that's what this was. The cash rate plus 2.5% is approximately where we're at with floating rates. And it's the change in the cash rate that will change our floating rates. That spread of 220. We're not expecting that to change down here. Now up here, let's imagine in our example, we just hold the property for 1 year. Now, of course, we're going to hold it for 10 or 15 or 20 years, but let's just go for 1 year to make it simple. And after 1 year, we've got real price growth and we've got inflation. Now, let's assume that our real price growth is quite large. Let's say it's 2.5%. 2.5% is approximately what we've had over the last 50 years. So over the last 53 years, 2.5% real growth is the average growth that's taken us from an index level of 100 here to our index level up here of 390. And so if we just imagine that the growth rate is the same as it was over the last 50 years, let's just throw that in as our first assumption. So we've got a real price growth, 2.5 on the value of our property. We've got inflation of 2.5, same inflation as appears down here. Now, what really makes, and we're assuming that we're selling the property after a year. I know you're going to sell it after 10 or 15 years and get a big capital gain, but let's just imagine that we sell it after a year and that normal conditions maintain. We're back in normal inflation and a normal growth rate, and the value of our property has gone up by 5%. And now we're looking at the return on our investment. We put in 200,000, and we've got value after tax of 26.3. Where did the 26.3 come from after tax? Well, we had a loss on the property because we made this much in income, in rental income, but we paid this much in mortgage payments. So we had a loss on the property, but a big part of that loss is shared with the federal government because this is pre-tax income. This is income that if we didn't use it to support our property, would have been taxed at 47%. That's what I'm assuming here. It would have flowed through and be taxed at 47%. And it's not being taxed at 47% because it's the loss here, the rental income being less than the payments on the mortgage, that loss is reducing our salary, our other income, before we pay tax. So it's a reduction in our after-tax income, but a lot of the loss is shared with the federal government because of negative gearing. There's a part of our salaries that would have been taxed at 47% that's not being taxed at 47% because this is deducted from our salary before we pay tax. And that's what this is. So our after-tax income is not reduced by this amount. It's reduced by 53% of this amount because we only get 53 cents in the dollar. Now up here, in the gains that we have, the capital gains we have, because capital gains are only taxed at half the rate of income in Australia, the reduction in our gains, in our capital gains because the property went up in value, is not as large as the reduction in our loss. So the government wants 23% of our gains, 23.5% of our gains, but it shares in 47% of the losses. So there's a loss on income, but a gain on capital. But the loss on income has a tax rate of 47%, and the gain on capital has a tax rate of half of that. So taxation is shrinking these pre-tax things, but it shrinks the losses a lot more than it shrinks the gains. That's the beauty of negative gearing. Negative gearing is a strategy for turning pre-tax income into capital gains. Pre-tax income that would have been taxed at a high rate into capital gains that are taxed at a much lower rate. That's really the essence of negative gearing. Now, it works well when you can get a lot of leverage, and it works well when you have growth. You need growth for it to work because you're turning pre-tax income into capital gain. You need growth, but that's the essence of it. And in our example, we're getting a after-tax return of 13.1%. And notice that that is above inflation. This is after-tax, above inflation return of 10.6%. If we subtract inflation out, this is an after-tax real return of 10.6%. So this is a great investment. If we could put this in place. with this kind of real interest rate and this kind of real growth and this level of inflation, this is a great investment. Now, what if we change some of those things? And the first thing that I want to change here is this. I want to say, what if inflation is higher? What if inflation was 5% instead of 2.5%? Then is our after-tax return going to be higher or lower? What's your intuition on that? If inflation is higher, is your negative gearing strategy going to work better or worse? It's going to work better, right? Because it's predicated on growth. And real growth is better, but inflation will do in negative gearing. Inflation will do. We would prefer to have real growth, but just inflationary growth in the value of the asset will make negative gearing strategy work. And you can see that here. I'm going to change the 5% inflation, which appears both in the mortgage rate and in the growth rate of the property. I'm going to change that from 2.5 to 5% here and here. We're expanding this thing and we're expanding this thing, but this is not being reduced by tax as much as that is. So in the net, it really works for us. Going to 5% grows this more than it shrinks our income down here. So our losses go up and our gains go up, but our gains after tax go up more. And it means that our after-tax return goes up more. And now we've got a real inflation-adjusted after-tax return of, what is that, 14.9%. So inflation is our friend in a negative gearing strategy. Over long periods of time where inflation appears in the growth of the asset price. Now, the next thing I want to change here, I want to go back to normal inflation, 2.5%, and I want to change this. I want to increase the real interest rate to 2%, from 0 to 2%. And that's basically an assumption that we are in this world instead of that world. That when inflation comes to, that when when in the post-COVID world, we go back to this and not to that. That's the assumption. Now, when I do that down here, go to 2% in the real interest rate, increases in the real interest rate are really our enemy. You can see that here. Now, after-tax income goes down to 8.9%. when this goes to 2.2%. So it really matters whether we go back to real interest rates close to 0 or real interest rates more like 2%, because it's going to affect us here and it's not going to help us up here. It's going to increase our cost of financing and it's not going to increase the growth rate of the asset. Now, something else. Let's say that we decrease the real interest rate. Let me combine a couple of things here. We decrease the real price growth to 1.5%, and we increase the real interest rate to 1%. So both of those things are bad, but we're still going to get to a pretty good result. So here we're going to say, let's imagine that the real interest rate goes back to 1%, somewhere between pre-COVID and pre-GFC. Let's say it goes to 1%. I think that's a reasonable assumption. That's a conservative assumption. And let's assume that this is not 2.5%, but it's only 1.5%. That we don't have the growth, especially the really high growth of the last 30 years, but we don't even have the growth of the last 50 years. We grow at 1.5% instead. Let's make that assumption. That's conservative as well. Let's put in these two conservative assumptions. Lower real growth and a higher real interest rate. Well, what do we get to? Well, what we get to is a return of 7.2%. Now, that is, after we take inflation out, that is a return of 4.7%. After tax, real return of nearly 5%. That means your money doubles every 15 years in real terms, if that was true. So what we're saying here is that in the negative gearing strategy, even in the conservative assumptions that we face the difficult conditions of higher real interest rates and lower real growth, it's still going to work pretty well on average. We don't know what's going to happen, but it's still, such is the power of well-conceived negative gearing property strategies that we will still get to something like a doubling in the value of your money every 15 years. After tax, inflation plus 5%, something like that. Now, what I'm really shooting for in these examples is helping you to understand that negative gearing strategies at a deeper level. How do assumptions about growth, assumptions about real interest rates, assumptions about inflation feed into what I should expect from negative gearing? Just trying to take you deeper in that. Most people have got no idea how that works, and so they can't really formulate sort of good strategies in their mind. So I hope you found this helpful. Let me remind you that my course is coming up, and that if you want to have a look at that, then go to windlestone.com.au and watch the video on 7 mistakes that investors make. That'll give you a really good sense of what the course is like. I'll see you at the next webinar.